Hey, so you're gonna get me in my Saturday morning garb, but at least it's all my Lone Ranger stuff. I don't know if we talked about this too, but I that's my hockey team. I know it's probably backwards for you, but all of my stuff is LOAN Rangers. That's the dollar sign with hockey sticks. So it's kind of a running joke, but it's on all of my stuff. So anyway, here's what we got. Here's your current position right here. So you owe about 353 on the first, about 78.5 on the second. First rate is 3.5, second rate is 3.56. You need $300,000. The available equity on this home equity line is 61 grand. So if you use your 61,000, you're going to need 238,000 bucks in the private money loan, and we're assuming that rate is 2.75. The total of all payments then would be 3443, and what that is your current P&I, the second mortgage, all of that is about 2,700. Then you've got the additional payment coming from the additional draw on your home equity line, and then you've got the payment from the new loan. So that's where we're getting to the 3443. The interest rate. So what I did here is I looked at, all right, how much is fixed and how much is on a variable rate? So when inflation kicks in and when the Fed increases the Fed funds rate, how much money do you have exposed? And you have got over half of the money is exposed, and the total blended rate of all of the money borrowed is currently 3.267. So I think I made the condition on this, if over a third of your money is exposed to a variable rate, that could be a concern, and we're over 50. So what I did then is, I did a third, because now I've got option one. So we do not have a home equity line anymore. We're doing a cash out refinance. I did 507,500 because I capped it at 70% of the 725 grand. It may not matter. I just wasn't sure. So if I change this a little bit, it doesn't matter too much. Then we've got an interest rate of 3%. The total PITI ends up being 2843 because there is no second mortgage anymore. And you've got these balances. There will be some costs incurred, and you're going to set up a new escrow. So even though you get this money back in the payment that you skip and in the refund of your escrow balance, I did count it here. That means the delta, the cash out to you at closing, is about 70,000 bucks. Now that means you're going to borrow about $230,000 at the 2.75. The total payment is actually the lowest of all options, and 70% of the money borrowed is fixed. So that's not such a bad deal. That is also the cheapest interest rate. So a couple of benefits to option one here. Option two, however, we're bumping it all the way up to about an 80% loan to value. We're going to cap it at the 575 grand, because anything above goes into jumbo money, and that's chaos. Now, there are costs associated to it. They also would, on a cash out refinance up to 80 on a high balance, they're going to charge points. So when we look at the total cost, the interest rate is higher, 3.625. The total monthly payment is $32.44, and you end up receiving about $125,000 out. The big deal is the cost. Now there are deductible options on the points that are charged, but it's pretty expensive. You're paying about 10 grand just to get access to the money. So drawback, rates higher, drawback, costs are higher. But it gives you about 80% of the money is safe on a fixed scenario, and the total is still under your $4 threshold, and the blended interest rate calc is still under 3.5. So in looking at that, the only element that I don't necessarily care for about why you're leaving, if you do nothing, the reason why we want to probably choose between a 1 and 2 is because a lot of your money is exposed to a variable interest rate, which means the odds are it's going to go up sooner or later, and it doesn't give you the lowest payment anyways. So that puts us into, do you want it's basically going to come down to how much of your money do you want to have set up in a fixed interest scenario versus how much do you want on a variable rate. And that's what it's going to be. I would probably personally lean towards option one, get rid of the home equity line, do a cash out refinance, take as much as you can up to that original balance threshold. It'll allocate you $630 a month that you can dump towards the variable rate of the private money loan, and that will, over time increase the fixed portion versus the variable portion anyways, and it has the lowest total carrying cost. So I'll send this to you so you can study it a little bit, but let me know if this makes sense to you or not. The only reason why you would choose this option is because you just don't like having so much money, 230 grand at a variable interest only payment, and you'd rather have more of that money to the tune of $55,000 secured on a fixed rate, even if that rate is a little higher. So hopefully that makes sense. Have a wonderful Saturday. I'm about to go do the same. And you can literally just say, hey, I like option one or I like option two, and I can proceed from there. I just want to get something locked before Monday morning, the 15th.